Hello breakers, and welcome back to another weekly market update on the SPY. Which feelings did you have over the last few days when you saw prices moving down like that? First hitting, then ripping through every support. First, the range low at around $4,060. Then next, our area between 4,020 to 4,008. And now potentially also ripping through the daily fair value gap at around 3,967. Was it excitement, first of all, for being able to buy the deviation of the range, and now potentially fear and uncertainty with the question in mind, is the bear back? I say let's not be guided by emotions but facts. I believe this is not the time to be bearish but bullish, at least for now. Therefore, in this video I want to show you why first of all you should prepare to buy if you are a trader, and secondly how you can control your emotions during red days and weeks like the one we've just seen. For me, it's all about your framework, but more on that later. So let's jump right in. For starters, let's recap. Last week we talked of a so-called pressure cooker range that we were trapped within. I said I expect movement last week, and movement we got. Just have a look. From the closing price on Friday down to our current low at around $3,950, we had a 3.5% move on the SPY nearly. And was this move to be expected? Well, looking at our correlation cheat sheet, the DXY, yes indeed it was. DXY up, SPY down. Look at the DXY again here on the 4 hour. Really, sometimes you literally can't make it up, the precision. So where does that leave us now for the week ahead? As always, we want to start our analysis obviously on the monthly chart. Looking at the monthly chart here and putting on our levels, we first of all want to have a second look here at this monthly level at around 4,080. It marks the monthly swing point that we broke in January and that started our current monthly uptrend. We can definitely move it over here now as we've started the new months. At the moment, obviously, the February candle doesn't look too pretty. However, not everything is lost yet, because the crucial level lies at around 3,861 on a monthly basis. Why? Because if we failed here, we would fail the current new monthly uptrend. This becomes clearer if you have a quick look at the line chart. We really don't want to close the monthly underneath 3,861. But February is not over yet, so let's move on to the weekly chart. Here the picture becomes a bit clearer, but at first sight not necessarily better. Putting on our levels, we realize that we did break on a closing basis this weekly swing point. Nonetheless, the key swing point obviously on the weekly again is the just named $3,861 level. And secondly, don't forget, yes, we've broken this swing point, but we are also inside of a weekly target box. We've just hit it at around 3,968. In other words, we are at weekly support, or at least in an area thereof. Finally, moving down to the daily time frame and getting rid of our monthly levels for the moment, and on the other hand putting on our daily boxes, we see that the weekly target box that we've just mentioned also lines up with the daily fair value gap as well as with a daily target box. In other words, we find a whole pool of confluences in this area of around 3,960 to 70, and I don't think the bulls will just give up this area of interest that easily. Opinions in trading alone obviously don't help along, so we need a clear plan of action. We will have a look at a clear plan of action on the 4 or even 1 hour time frame. Before we do that, however, let's strengthen our argument for this area to be at least intermediate support a bit more. Yes, it is true that we broke the aggressive daily uptrend and rejected from it, but one, we are in an area of resistance now on the DXY, and even if the DXY pushes up a bit more to get this weekly liquidity or fill in this daily fair value gap at around 105, you can expect some resistance, and therefore, on the other hand, some kind of bounce here or a bit lower in the SPY. And two, let's have a look at our cheat sheet. What does this tell us? It tells us that we are in an area of low momentum while at the same time hitting support. This doesn't mean that we will bounce immediately. However, it means that you can expect some kind of reaction. So how can we use all of that knowledge to find an actionable setup? For that, obviously, we need to go down to our execution time frame. In other words, at least the 4 hour. Looking at the 4 hour time frame, then we see that we are in a clear downtrend, creating a lower high after lower high after lower high. Even if we take this last aggressive lower high, we are in a clear downtrend. At the same time, obviously, we have created daily fair value gaps above us and also daily bearish target boxes. In other words, yes, I do expect us to bounce during the week. Nonetheless, you don't want to be too aggressive. What you want to wait for is definitely at least a market structure break on the 4 hour, and then maybe if you can find support in a potential 4 hour target box, you can take price up maybe to around 4,100, then take some profit there and take it from there. But given that we've just moved down for several days, even weeks, if you consider this whole downtrend, and that we have entered an area of support on various time frames, the daily as well as the weekly, I expect us to bounce and potentially go for at least $4,100. If you found any value in this video so far, consider subscribing to my channel. And now let's come back to what we started the video with, namely emotions. Controlling your emotions in trading is at least as important as being able to find a good setup. In other words, if you take action in trading, you should never base your decisions on emotions. On the contrary, they must be based on iron rules, rules you give yourself. I call these my framework. Explaining my whole framework obviously is a topic for a whole video, so if you're interested in that, let me know in the comments down below. Generally, however, I differentiate between a trend time frame on the one hand and an execution time frame on the other hand. Let me illustrate that a bit better here on the charts. Let's say I want to trade the daily trend. So I could enter a long on my execution time frame within my target box if certain conditions were met. In our latest case, for example, moving down to the 4 hour time frame, last week I was interested in longing a deviation of the low of the range. However, I couldn't because we never had a trend change on the 4 hour time frame. It just didn't come. So I was safe, I couldn't enter. Zooming out to the daily and summing up, the key idea simply is the trend time frame dictates whether you are allowed to take a trade. Last week this literally saved me from jumping on board. Price wise, look at it. Cut out the noise. A week ago people were overly bullish when we were up here. Now everyone seems bearish again, just when we are literally entering areas of strong support. Most likely we will not bounce immediately. The DXY just seems too strong and we've just entered our area of resistance. We may go for more liquidity up here. Nonetheless, concentrate on the facts in the chart. The charts tell you that we are on a weekly basis still bullish until we break on a weekly basis 3,861. On the daily bigger picture, same. Our last stand is down here at 3,807. Are we gonna go there? I don't know. The plan on how to enter is pretty clear. We talked about it. Simply don't let yourself be governed by emotions. And if you want to find out more about how to sharpen your trading skills and how to conquer your emotions, definitely consider watching this video next. With that being said, talk to you soon and thanks for watching, my friends. Bye bye.